Good evening, everyone. I'm Ross. I run Smith 150 Property Accountants in Hamilton. And obviously, we're here tonight to speak about next step in property. And it's about adding value and getting ahead in property. So we've run a few different seminars. We've run some on basics, which go before this. This is kind of the intermediate webinar. So it's for people who've been investing a little bit, have one or two properties, or just people who are wanting to get ahead. Um, so if you're a very experienced developer and you've been investing for the last 30 years, this might be a little bit below you and it might be a sort of basic things, but you're still most welcome to listen in. Hopefully you'll get some good information. We're also recording tonight. You'll get an email through tomorrow with some basic information and a few websites and things like that that is helpful. And you can also, just send us an email back and we can send you a copy of the recording if you'd want one. And we're quite happy that's freely available to anyone. A little bit about us. I've run Smith Property Accountants for the last 16 years. On the 1st of April, and yes, it was fantastic timing. Just during lockdown, we merged with 150 Group. And the whole reason for that was to bring some other services. It means we can bring you a whole lot more. We can help you with your mortgages, insurance. We do a lot more with your general financial services, your KiwiSaver investments, your goals, your financial plans, your wealth creation, and your retirement plan. So I'll talk a little bit about that later, something that you can do for free with them, which is a great idea. And otherwise we'll start getting into this. It's a little bit more about myself. I've been property investing for over 20 years now. Hopefully I look a lot younger than that. We've invest in long-term hold residential properties all through that time. We used to trade residential properties but found it just a bit too time consuming, and realistically I'm not a builder, I'm not great at adding value. So we do commercial trades now, we do commercial holds, and we do small subdivisions, sort of 10 section, that sort of thing. So that's what I love at the moment, is more the commercial front, but still trying to buy more and more residential properties. We put a whole lot of videos, information on our website and Facebook, so check that out. There's a few decent recent ones about a good example in Hamilton as well. I'm also a member of Waikato Property Investors Association, been a member for over 20 years now, I think, and I've been on the committee for the last 6 or 7 years, so I'm heavily involved in property. You'll see me on Property Investor Chat Group, you'll see me on Property Talk. I live and breathe property all day. So just a disclaimer, this is general advice and not specific advice. If you're looking at buying a rental, looking at doing some of these things, come and see me. Doesn't matter where you are in New Zealand. Through Zoom, I find that's the best platform at the moment. You actually get more done in a meeting, and we actually offer discounted Zoom meetings as well. So So starting off, why property? And we've covered this in the basic webinars, so I'm not going to spend a huge amount of time on it. But basically, long term, you should be looking for two things. You should be looking for a debt-free personal house and some passive income. Everyone's a little bit different, and you don't have to be one to lie on the beach for the rest of your life, but you need the level that you're happy with both of these. Obviously, I talk all the time about property investment, and this one I'm going to focus a little bit on some other things, and then mainly in property for at least the second half of this webinar. But there's other things that also help you. There's your KiwiSaver, there's your job, there's other investments, there's your personal home, and there's general money management. So what's the easiest way to make money? What's the easy way to have money raining down like it is in this picture? Well, the easy money is actually KiwiSaver. So say you're 40 years old now, you've got 30,000 in KiwiSaver, you're making 90,000 a year, and you're looking at retiring at 65 years old. How much is that going to be worth at retirement? How much is your KiwiSaver going to be worth? And obviously you're putting in 3% and your employer's putting in 3%, plus you're getting the huge $500 from the government. But there's different options. So looking on Sorted website, defensive will be worth about 161,000, or it'll give you 100 a week passive income. If you go up to maybe the balanced one, it'll be worth 214,000, giving you $175 per week. If you want to go aggressive, we're up to 289,000 or 303 per week, and that's from sorted.org.nz. So to me, this is actually really important to think about. This is actually a good way of building up wealth, and it's actually a way of getting passive income, which is really important. So you can get an extra $203 per week. Is that worth considering? My opinion, yes. General thing, if you've got bank products, like banks are there to loan you money. If you've got insurance through the banks, if you've got KiwiSaver advice through the banks, chances are it's really poor policies and really poor advice. So to me, I would always go to an outside expert. I would never talk to um, a bank about insurance or KiwiSaver. So if you've got your insurance with your KiwiSaver with a bank, I would think about getting some other advice and just see what other options out there. Is it performing the best for you, or could you reasonably, actually end up with more retirement, more passive income? And it's just important to review your KiwiSaver, review what you're doing, and see whether it's right for you. So first simple thing, KiwiSaver, make sure it's working for you. Next simple thing, money management strategy. So generally what happens with people is all their money comes in, their wages come in, and their pot's full, they've got all this money. And then next minute, all the money's gone out again, and there's nothing left. That's the standard of what happens to most people. So what is left? The time you go partying, you buy your helicopter, your planes, your toys, your whatever is in this picture. By the time you go and get some coffees, by the time you go out to dinner, time you pamper yourself, what is actually left at the end of it? And for most people, there's actually not much. Generally, what goes in goes out, and there's actually nothing left at the end of it. It all gets spent and slowly drifts away. So a really simple money management strategy is all the money goes in and then we separate it out. So you might have an account for everyday spending. You might then do automatic payments into a holiday account. So you start saving for your holidays, APs to a health account, house account, savings account. You might have education or other accounts. But basically by just automatic paying those off to a whole lot of different accounts, what you'll find is you actually start accumulating a whole lot of money in these different ones. So when your holiday comes around, you've actually got the money to pay for it. You're not just chucking it on the credit card and hoping. House costs come up, you need to paint the house, or the rates comes up, some health costs. You've actually got money and you're actually starting to build up an extra savings. So this can be a real good way of taking all that money out of your account and only leaving in your account what you want to actually spend. So just a real simple money management. If it's not there, you can't spend it. Make these accounts hard to access, maybe so you actually have to go into the bank to access them, and that can be a great way. So what does it really matter? If you can save $10 per week, it's $13,000 for that 40-year-old retiring at 65. It'll gain up to $17,500, give them extra $18 per week. That's not that exciting. But if you could save $50 per week, that's $84,000 at your retirement. That's $88 of extra income. So if you could make $200 extra from KiwiSaver, maybe up to $300 a week, plus another $88, you're starting to get $400 passive income or extra income per week, just by doing very small things. I'm pretty sure this is our last one. BNZ total money. So say you do have different accounts and you've got an everyday account, but you've got some money in your house account. You've got 16,000 sitting in your savings and you've got some in a kid's education fund. Altogether, you've got 38,000. Maybe you've got a bank loan for 40,000. So normally that might be costing you 3% interest, $100 per month. So we've got money there, but we've got a loan there. Generally, a lot of people would use revolving credits, but I think it's something like 95% of people revolving credits don't work, and basically you end up just sitting at the limit all the time and it never gets paid off. So this is a different way of doing it. You have all these different accounts that you put money into your APs in, and you use BNZ total money so that the 40,000 is offset by the bank accounts. You're then only left with $2,000 net loan balance. At 3%, that's $5.45 per month. So you've saved $95 per month. Again, it's not huge, but it's just different ideas of how you can just save a little bit, which is all going to build into you having more assets and having a better retirement. On to property things. Who thinks that whatever property you touch is golden. And yeah, property is going to be amazing. You just need to buy a property, and you need to buy it as quick as possible. Well, a lot of people do look like that, and we've got the numbers on a property. This was an example. It's a couple of months ago now, so I've got a slightly higher interest rate. Someone was looking at buying a 2-bedroom unit. Generally, to me, a unit is not going to get such good not get so high capital gains. It's restricted on what you can do. You can't subdivide it. You generally can't do a lot of improvements. Maybe you can turn it to a 3-bedroom, and that would be a valid option if you could do that. But there's not much you can do. You can't do a minor dwelling out the back. You're restricted by your other owners. You generally have a body corp, and yeah, other hassles and things. So the reason to have a unit, to me, is all about cash flow. You want to get a whole lot of cash from it. So this property, average sort of area, $460 a week was the rental appraisals. I worked on 50 weeks because it was an average area. It's $23,000 per year. $23,000 rent divided by 400,000 is a 5.74% gross yield. Then I've gone less all the expenses. I've got accounting in there. I've got insurance. I've got interest at 3%. And yeah, maybe you could say it's slightly low at the moment. Some property management, some rates, some repairs. It was a block unit, so it's pretty bulletproof, but still long term, you're probably going to spend 20 grand over that next 10 years. I allow some for seminars or education. Maybe you join Waikato Property Investors, or whatever area you are, the local Property Investor Association, as a great way of getting information, getting the Property Investor Mag, that sort of thing. And I've got that link later on. A little bit of travel, so 100 kilometres of travel. 23,000 in, 22,000 out, you're making $783. So to me, that's just not worth it. You've got a unit that's going to have limited capital gain, limited potential, but it's hardly making any money, and that's at 3% interest rates. So if over the next 10 years, rent slowly goes up, expenses go up, and maybe interest rates go up to 5% to be conservative, you're then looking at losing 2,300. So your cash flow property, your unit that you want to make lots of cash from, is actually losing money. So just something to bear in mind, that not every property is golden. Not all property is going to make you millions and millions of dollars. And sort of think, what is the real aim of that property? And yeah, to me, a townhouse unit, it's all about cash flow. And yeah, this example is just really lacking and doesn't have it. Some key stats on that one as well. You'd need 443 to break even, so the 460 worked. If you made it principal and interest over 30 years, you'd be having to put in 7,500 into it, and obviously more if you went shorter terms. So yeah, just something interesting to sort of bear in mind, that if you are looking at some principal interest, yeah, that would be extremely negative. So what we really look back with is, what is our aim? It's a debt-free personal house and passive income. Does this property help us achieve these aims? And my thoughts at the moment is that no, it probably doesn't. Yeah, it's going to give me a tiny bit of passive cash flow, but if interest rates go up, that's going to disappear. Am I going to get amazing capital gain? Potentially not as good as something else. So I could look at buying it, holding it long term, selling it in 10 or more years to pay off some of my personal debt, which might work to some degree, but I'm really gambling on capital gains and with a property that's not perhaps as suited to that as some others might be. Just like that, you know, if you do have questions, you can write questions in the in the question panel, and I'll try and answer them. Generally, if they're really basics, I won't answer them. They're in the basic webinar. If it's really advanced, I won't answer them. That's more in more advanced webinars. Any personal questions about me, yeah, I don't really talk hugely about myself. So yeah, I don't answer personal questions. And if it's coming up on a future slide, then I'll answer it there. So my next sort of slides, we've got a case study. I've completely forgotten what their names were for this, but this is a movie and I just like the picture of it. Jack and Jill, sorry. They're actually brother and sister, but for my example, say that they're husband and wife. We've got Jack and Jill. They're going to buy a house for $700,000. They're amazing with money, and they're going to pay it off over the next 15 years. And it's going to be a $500,000 loan because they've got $200,000 cash to put in. So they're going to do really well. They're going to pay off $3,453 per month, and they're going to end up hopefully in 15 years' time with a house worth $1.4 million and it being debt free. So obviously that's a fantastic starting point. Jack and Jill are doing really well. They're good with money. And really what we're looking at is, can we be smarter than that? What could they do better? And these options, I'm talking about Jack and Jill as a homeowner. And if you've already got a home and not interested in doing something like that, that's cool. All these options also apply to property investment as well. But it's just an interesting thing to think about. What happens if your personal house has got no opportunities? What happens if you sell it and buy something else that does? So smarter might be something where you could subdivide it. Maybe you could have flatmate income, which is taxable. Boarders, which includes regular meals, are not taxable. Maybe you could have Airbnb, and if you're going to earn more than 60,000, watch GST. Make sure you get some advice on that. Maybe you could do a minor dwelling. Maybe you could convert the garage into a legal separate unit. So there's so many things that you could look at to be smarter. So we're going to start with one of the first options. Rather than buying it for $700,000, what happens if Jack and Jill buy a property for $750,000? They spend a little bit more. They live in it for a couple of years and then they subdivide and sell. Straight away, I'm thinking tax. Starting point, if you subdivide a property and sell it, is taxable. And there is quite a few exemptions to that. So what we need to do, look at first, Brightline rules. We're looking at Brightline, is it predominantly your family home? So as long as Jack and Jill are using the whole property, they've got a paddling pool out the back and a tramp, and they're using the whole section or just parking on it, then they're predominantly using the property. If they had 5 flatmates to the 2 of them, that's not predominantly their family home, so you wouldn't get the exemption. If there was 2 houses out the back to their 1, it's not predominantly their family home, they wouldn't get the exemption. But in most cases with a subdivision, if it's just Jack and Jill living there, they're using the whole section, they'll both get it predominantly their family home, and therefore the exemption to the Brightline. We're then looking subdivision rules. General subdivision rules, yeah, you subdivide and sell, taxable, but there's an exemption for personal home. Exemption for trust is not really nearly as good, so it's much better if there's not a trust and it's just in personal names. And yeah, generally as long as it's under 4,500 square meters, you get an exemption for personal home if it's your true family home. So we need to consider tax, but most likely there's no tax involved, and I'd suggest you get expert advice about that. Cost for subdivision, Jack and Jill say in Hamilton, it's about $60,000, and every area is different, but somewhere like Auckland you'll spend more, but then your property will be worth more as well. They're spending an extra $50,000, so maybe over 3 years that's going to cost them $10,000 extra in their interest. So instead of buying it for $750 and having a $500 loan, they're buying it for $750, so they'll have a $550 loan. There'll be some costs to sell the section, maybe $12,000. Maybe they sell the section for $300,000, no tax with some smart planning. So our debt of $550,000, because it was $750 less their $200 is $550, it means it would be down to $332,000. It means our 15-year mortgage that they were going to pay off really quick over 15 years is actually down to 9 years, 2 months. So to me, this is, a really good trick. It's a really good way of getting that mortgage down, and they end up and they end up in a really good position, debt-free home after only 9 years and 2 months. Can we get smarter still? Well, yes, we can. So maybe you buy it for $750, you subdivide it, and you build on the back. We still need to consider tax. But yeah, the same way, it shouldn't be taxable. So say we cost $60 to subdivide, we spend $400,000 to build, extra interest over the 3 years, again $10,000. What we might do is sell it to a rental entity. So yeah, we subdivide it off. We use the exemption for personal home to sell off the back section to a rental entity. We end up with non-taxable sale, $300,000 capital gain to Jack and Jill. The rental entity then buys it for $300,000. Tax zero. The debt for Jack and Jill was still 550 down to 332, 9 years, 2 months. So we ended up with a debt-free personal home quicker. Is there more? So the next bit is, yes, there is more. We're looking at trying to hold a property long term. And this is property graph in New Zealand since 1996 up till now. 6.3 is the green line. So that's about what property goes up. So in theory, we expect property to keep going up the same and median house be close to $1 million in 10 years' time. It's a guess. No one knows what's going to happen with COVID-19 exactly. It's a big guess, especially in that short term. But to me, long term, banks printing money, you're likely to get high inflation at some point and you're likely to get the house prices jumping up. But it's a big guess. But obviously, if they keep it as a rental, Jack and Jill are hoping their house will jump up over 10 years. Yeah, blue line is Hamilton, which normally lags behind, and red line is New Zealand, driven by Auckland. So Auckland booms first, Hamilton stays flatter and then booms up. Hamilton goes flat, Auckland starts to take off, and then it catches up again. And that's New Zealand average, so Auckland would be above. Generally, most areas are the same. Auckland goes first, Hamilton, Tauranga goes second, Wellington, Christchurch, Dunedin, the main sort of centres. Then it starts to spread out to the smaller areas, the Tokeroas, the Wanganuis, the Invercargills, the Palmerston North, that sort of thing. And generally what happens, it's the same at the end. Auckland stops booming, it goes flat, and then the rest of the country keeps going for a little while. But yes, sooner or later, it generally follows the same trend. So just interesting if you're thinking, wow, Palmerston North is booming, Auckland slowed down. What's likely to happen at Palmerston North at some time in the future? It's very hard to know when, but it's likely to stop. So yeah, it's just worth thinking that, those sort of things. And this one costs $300,000 for the section, $400,000 to build. We're looking at renting for $650. What are our numbers like? I've done them on a 3% interest rate, so again, we'll be looking a little bit lower, but we're basically looking at $700,000, spending some legal fees, maybe a valuation, getting a cash contribution back, so still borrowing $700,000, 52 weeks because it's a brand new house, $650, 34,000 rent divided by 700,000 gives us a 4.83% gross yield, which is okay, it's not amazing. Less all expenses, low repairs because it's brand new, we're looking at making $2,600. With the lower interest rate, that is actually going to help a little bit. So that is going to be another $3,000 that would get added to this. So this would go up to about $6,000 positive. So yeah, this property, while not amazing cash flow, it's going to start to give you some cash in. Over 10 years, if interest rates jump up to 5%, small loss, but still pretty good. After you take out chattels depreciation, you'll get good depreciation on the carpets, curtains, dishwasher, stove, heat pump, fences, decks, driveways, paths, all the different chattels. So you'll end up having no profit for tax, no tax to pay. So to me, numbers are average, okay, but it is a new build. So you're going to have no hassles, low repairs. It's got insulation. It meets the healthy homes rules. Maybe you'll get some initial capital gain, or maybe you've already made it on the section. So what we're looking at overall, 15 years time, personal house debt-free. We're going to have an extra 5.8 years of savings. Put that into the rental. The rental is going to be worth 1.4. Debt, 700,000 to do it. Less the personal repayments, about 500,000. So what's going to happen is our first example of just them just paying off their mortgage, they'd be debt-free over 15 years. Second option is selling the section, they'd be debt-free over 9.2 years. This one here, we're looking at being debt-free, plus having 900,000 equity in our rental, and plus it giving us passive income of about 10,000 at that point. So to me, something like this really works and puts Jack and Jill in a better position. Just to answer a question. So what happens if you subdivide a rental property to build on the back and you move into the new build as your personal home? It sort of depends on what it is. If it's a rental property, it's going to depend on who owns it. So if you owned it in your personal names and you subdivided it and you moved into the back section, you're not selling, so you're not going to have an issue with tax. You just keep it in your personal names. If it was in an LTC or a company, a look-through company is still really a company. If you subdivided it and then sold it back to you personally, you would be caught by tax. So yeah, you'd have to be very careful if it was a rental property in a company or an LTC to start with, and then you were subdividing and putting your personal house on the back. That wouldn't be ideal. If it was your personal house on the front, the old house, and you were subdividing it, you built a house on the back, you moved into it, and then sold the front personal house, that would be another twist on what we're doing, and that would be fine as well. So that's two options, starting to get better and better. Then what we go to is option 3. So duplexes, the dream come true basically, which is basically buy a big section. Instead of the 700,000 we were initially looking at, we're looking at spending 850. So buying a more expensive property that's got a bigger section, but we can put a duplex on the back of it. So a duplex is two houses joined together. Often the garage would be a common join, but there's lots of different ways that you can do it. So you'd end up with your personal house on the front, two brand new houses on the back, so you'd be getting two rental streams. So we would be buying it for more, but our section would be worth more. So we would subdivide it. It's going to cost us more for the duplex. And again, we're still going to have to think about tax. Our numbers are just going to get better. So duplex on the back is going to cost us more. You're going to have a bigger mortgage, but you're going to create some initial equity by doing it. So it's only going to cost you $1,050,000, but it's probably going to be worth 1.2. So you've created 150,000 of equity. Your rent, you're looking at about $1,200, 52 weeks, 62,000. Your gross yield is getting higher. Less or expenses is two houses, a bit more repairs. That you're starting to get much better cash flow. After high chattels depreciation, you're actually still looking at a taxable profit, but you're starting to get really good numbers. If you then recycle that in and pay down debt with that money, over 10 years or 10 years time, you're looking at rent jumping up, interest jumping up, but you're still looking at about 23,000 positive. So duplex on the back, fantastic cash flow, some equity gain to start with, works out really, really well. Looking at those sort of key stats again, you need 876 to break even, you're getting 1,200, awesome. But if you put it principal and interest over 30 years, you're still looking at actually losing money. You're looking at losing about $6,000. So really interesting with that, that even though it's a great rental giving you great cash flow, it's actually still going to lose a little bit of money. So what I would do with this is, say it did cost you that $1,050,000, I wouldn't have one $1,050,000 loan. I might split it up into three lots of 350,000. You might do one interest only, one principal and interest, one of those 1 year, one of them 5 years, and the other one, depending on your cash flow, you'd go P&I if you could, so you slowly pay it down, or if your cash flow was struggling a bit, you might do the third one interest only as well. But it means you can go principal and interest or interest only, and you can do different terms depending on what your situation is. If you're really aggressive at the moment, you'd go 1 year because it's a great rate. If you're a bit more conservative and just want security and knowing what the repayments are, you'd do it over 5 years, so you can get some great rates. Question, would you need to have all those loans with the same bank? It depends. Like generally you can't borrow 100% from a bank. So if you're using a two-bank approach, you would generally, and I think I cover this a bit later on, you would generally do maybe 70% from one bank, secured over the rental loan to say the LTC. The other 30% you do secured over your personal home with a separate bank, loan to the LTC still, but yes, security over the personal home. So often, yeah, for that sort of to borrow 100%, you normally have to, yeah, mix up the banks, or if you're using one bank, use your personal home for security as well. Cool. I'm hopefully about halfway through. So on to the next sort of opportunity. What's something else that you could do? And yeah, something that I look at all the time is, what do you already have? So you're rushing out to buy a rental property and you're desperate to buy another rental. Well, yeah, what easy options do you already have? And I sort of call it low-hanging fruit. So you'd look at things like, is your personal house subdividable? I once had a client, we looked through a whole lot of different questions for about an hour and struggled to find things that would work for them. And then at the end found out that their personal house we could subdivide into 5. So we could put 5 separate rentals on it. They were fantastic. So it was better to focus on that than rather than trying to buy a rental that didn't really work for them. So yeah, look at what you already have, look at what your family already has, personal home, rental properties. This example is a minor dwelling. So yeah, minor dwelling is basically you've got a big section that's not big enough to subdivide, but you can put a separate unit on it. Normally a 2-bedroom unit, and a lot of councils are under 60 square meters. So this one here, you can see it's 58. So yeah, 58 square meters. It's got 2 bedrooms, it's got a bathroom, yeah, kitchen, living. It's just a nice new home. It's brick and tiles, so it's low repairs. It's brand new, so yeah, tenant friendly, low repairs, low heating costs for tenants. Got insulation, meeting your healthy homes rules, high depreciation. There's lots of good pluses for it. We then look at the numbers. This one I've dropped down to 2.65%. So we're looking at, yeah, house maybe costing $220,000 for a minor dwelling, and that's going to depend really much on where. That's around about a Hamilton price. You're going to have some cost to buy it. You might do some sort of inspection, surveying, or it might be some sort of valuation, and you'll probably get some sort of contribution from the bank. Brand new, 52 weeks. I got a property appraisal from QRM, Quality Rental Management in Hamilton, and they had a range, and I took the middle of that range, which was $445, just for a reasonable area in Hamilton, not amazing. So 52 times 445 is 23,000. 23,000 divided by 220 is 10.52% gross yield. Before we were looking at 4 or 5% and saying that they were okay. This one's, yeah, over 10%, and it's because you already own the land. Then we've got less all the expenses. Your insurance is going to go up a bit, but it's same title, so not a lot. Your rates is going to go up a bit, but not a lot because it's same title. Low repairs because it's brand new, and then I've got allowance for other things. So you're looking 23,000 in, 12,000 out. You're looking at making 10,000 passive income from this minor dwelling. It's pretty good. You'd then get some chattels depreciation, bring your taxable income down, and I'm showing all this income going to the lower earner at 17.5% tax, so you pay less tax. What we would do in reality is this is on the personal house's land, so we'd claim a portion of that interest on the land, and that would help bring this profit down and bring the tax down as well. Looking at the 10-year picture, rent will be higher, interest rates going up, costs going up in general, but our cash flow is actually getting better and better. So we're looking at making, even with interest rates going up to 5%, being conservative, you're looking at making a really good cash flow. So that's the key reason to do minor dwelling. It's all about the cash. What's the issue with a minor dwelling? Well, the issue is it's all on one title. So generally you've got first home buyers. They're not going to be able to buy a house and income. You've got normal home buyers. A lot of them are not going to be looking at house and income. So you're left with investors, big families, or someone who actually wants a home and income. So rather than having a big market where you've got a lot of people, it's going to shrink down. So it could be harder to sell, and you're likely to get less capital gain. So question here, we've priced up our minor dwelling on our section, conservatively cost 250,000 per week. Sorry, 250,000 cost, including the development contribution, consents, etc. But it was only going to add 200,000 of value, and that can be a problem. Like I said, it's very good for cash flow. If you're spending 250 and only adding 200, you're losing 50,000 of equity. You're going to have a lot of cash flow to make that worthwhile again. So yeah, to me, I probably wouldn't do that. I'd want the minor dwelling at least to add its cost. So if it was costing you 250,000, you'd want the value to at least go up 250,000, so you're not losing equity. Otherwise, yeah, it might cost you the next 10 years just to get that equity lost back. So yeah, I'd want an equity neutral and then really good cash flow. definitely not an equity loss. If I was doing a subdivision, I'd want a gain of 100 to 200,000 plus really good cash flow. And that's the difference between the two. Minor dwellings, good for cash flow, bad for the equity side of it and long-term gains. Subdivisions, you should get both. You should get an equity gain and good cash flow. Some obvious things. Personal debt, no tax deduction. Rental debt deduction. So one of the easiest things that we concentrate on for tax planning is we want to make more interest deductible. Really simple. We're looking at how do we put more debt on the rental legitimately. So in general, if you owned a rental in your personal name, you borrow an extra 100,000 to pay off your personal house, that's been used to buy your personal house, so it's not deductible. Someone's just asked again, and I'm happy to repeat this, why are minor dwellings bad for capital gains? It's because you've limited your market that you can sell them to. You can only sell to property investors, large family home buyers, or someone wanting a home and income. You're probably only looking at 10% of the market or less. You won't be able to sell to the normal market or first home buyers. So carrying on with this, we want more interest deductible. So example, Jack and Jill have another rental. It's in a company or a trust. What can we look at? So this might be a standard balance sheet, and this is done off our Coombe Smith rental example we use in Xero all the time. It would normally be Coombe Smith rental property example limited or Coombe Smith rental property example trust. And you're looking through the balance sheet. You've got some money. Not many property investors have 50,000 sitting there, but these guys do. They've got some land and buildings worth 1.6 million. They've got a shareholder's current account. They've got some other things. They've got a bank loan. What we want to focus on is that shareholder's current account. This means that Coombe Smith rental property example, maybe limited, owes the 323,546 back to Jack and Jill. So what we're looking at doing is if we borrow that 323,546 in the company and we borrow it correctly to repay Jack and Jill, then we can get an interest deduction on that loan. So we could pay off their personal house where there's no deduction and add it into this rental where there is a deduction. So the company or trust borrows the 323,000. It needs to be done properly. You need to follow the right process and have the right minutes and things. So make sure you get advice on that. Interest at say 3% is 9,700. Your possible tax saving, 3,198 per year. So it's actually really good tax saving just by doing that. So generally, if this is sort of 100,000 or more, it's probably worth looking at. It might save you $1,000 more in tax. So when you get your financial statements, and you'll always see it if you're one of our clients, in our letter we'll say that the shareholder's current account is X. Can we look at reshuffling it around? Can we borrow that in the company to then save tax? Next example, renovation. This is just an example. It was a property bought in February in Hamilton. Purchased 333,000, a 2-bedroom unit. The rental appraisal was $400 per week. It's a 6% gross yield, or it was 2,600 cash flow positive. Probably based on 3% interest rate. It's okay. There's nothing wrong with it. I based it on 2.65%. So you've got the 2-bedroom, 333,000, got some costs to buy it, legal fees and other things. Maybe we're getting $51, 51 weeks, 20,000, 6.11% gross yield, less all the expenses, we're making 2,600. Interest rates jump up to 5%, we're losing a little bit. It's okay, not terrible, not amazing. What happens if we do a renovation? We spend 33,000 renovating it. We put in a couple of new heat pumps, one in the main living area, one in the master bedroom. We do some carpets and curtains and lights in the bathroom a bit. Well, the rent for this property then went up to $470 or $70 extra per week. That's 3,570 extra rent. That's a 10.8% gross yield. The cash flow then moves up to 5,254. or it's an extra 2,700 per year. So it's just an easy way. It's a pretty simple example. It's not amazing figures or anything like that, but just an example how you can spend a little bit and you can get it back and get some extra cash flow. Generally for renovations, you want 10% or more because you want some of those things like carpets and heat pumps wear out and you'll need to replace them long term. So you want some money to pay back this 33,000 over say 15 years and also some to make a profit. So yeah, 10% plus. So the numbers, if you renovated it, yeah, working on 2.65%, you're sort of looking at making $5,000 from that renovation, and it's pushed the gross yield up from 6.11% up to 6.66. And just like I said before, make sure you think about the replacement cost, that you need to replace some of those items. In the beginner seminar, I've talked about different ways how you can find a property. And yeah, the main thing what I'm saying in that is think outside of the box. Think of your different things, developing relationships with agents. Think desperation fear. If you see people panicking from coronavirus and worried about it, that can be an opportunity for you. Having a specific plan, so telling everyone that you want to buy a two-bedroom unit in Hamilton that could be converted into three. Your agents can then start thinking about that and they might find something for you. A flyer drop can work, never worked for me. And an icebreaker that I'll go through a bit more. Another one to add on to that I did in a recent blog was targeting agencies that are not so good. So in a lot of areas, you'll find that there's agencies that don't sell a lot. They're generally either amazing real estate agents and do really well in a boutique market, or they're really, really hopeless. So what I would do is go through those smaller agencies, look at their listings, and often you can find opportunities from the hopeless ones. So yeah, just an easy thing to look through all the smaller agencies rather than focusing on the big ones. Cool. So with Icebreaker, we're looking at this property here. We're looking at what sort of things can we do for it. So what I'm looking at is where is all the land? Is there opportunities what we can do for it? So say you owned this property, what you could be doing is looking around your neighbors. These are all people who you hopefully know, so you could probably knock on the door and go, hey, Joe, love to buy your property. Any chance you're looking at selling? Worst you're going to get is a no. Better yet, what you could look at is maybe there's some land that you can't utilize. Maybe this is not wide enough to subdivide and you can't get access to your back property. So maybe what you could do is look at your neighbors. Maybe this guy's got this bit of land he doesn't really want or need and would take some money. Maybe this guy's got a bit of land that he doesn't really want or need and would take some money. So maybe what you could do is buy those bits of land and give you access to this. So maybe you could put a house in here, and use this for access. So yeah, just different things to think about. Start looking at what is your properties around you and what's the opportunities, yeah, close by. And I call it breaking the ice because you already know the people. So it gives you that icebreaker. You can break the ice because you already know who they are. Another property, for example, yeah, big bit of land in the back. This might not be wide enough to subdivide. This might not be wide to subdivide, but maybe you could buy this one and then get access in through here. So by having the two together, in that one there might actually be room for a duplex, or potentially, yeah, could you put a duplex here or a property here, duplex here, driveway through the middle. Yeah, it's just worth looking at some different options and trying to think of different things how you can do it. How do I buy? I have this picture up because generally you don't need cash and most people don't have cash. And just another way that you can look at things is, I've gone through in the Rental Basics webinar some different ideas on how you can buy it, fund it, and things like that. This one I'm focusing on, yeah, can you buy it with other people? The good thing about buying with other people is it reduces the risk. So it potentially means you could go for a bigger and better project. You might undertake a subdivision that otherwise is too big for you. So doing it with other people reduces the risk. There's different ways that we can structure it. And yeah, if you're a client, come and talk to us about this. If you're not a client wanting to do something about this, come and have a meeting with me. There's smart ways that you can structure it so that you could take a piece of the property each, which can be a great way. And you can do that without income tax and GST if it's done right. So that can be a great way of doing it with other people. Be very sure that you have an exit strategy. So often to me with other people, it works well. Say you're going to do a little subdivision, subdivide into 4 sections, sell the 4 sections, pay GST, pay tax, end up with so much cash. Then you can split that up between the two of you. That would be a really easy joint venture or doing it with someone else because you're ending up with cash at the end. So generally selling things is easier. If you're going to hold it for long term, you need to think, what is your exit strategy? Are you thinking 2 years and your mate's thinking 10 years? You've got to make sure you're on the same page and always get legal advice from it. Yeah, looking at things like a shareholders agreement stipulating who does what work when and what do they get paid, who puts in what money when, what happens if one of you die, what happens if one of you lose your job and you can't put in money. Start to think about all those sort of things, and they do get complicated, but there is some opportunity there as well. Just some general information. Yeah, the Brightline was 2 years. It changed to 5 years, 29th of March 18. There's obviously an exemption for your personal home, but just be careful. It has to be predominantly your family home. So watch what I was saying before, like things can be if you've built for 12 months and then only lived in it for 6, that's not predominantly your family home. You'd have to live in it for 13, for example. You watch out if you've got boarders, flatmates, you've got other properties on there. So the general thing is if you buy a rental property, sell it within 5 years, the gains are going to be taxable. Just be careful that there's lots of other rules. One I haven't put on there is the builder's rules, but yeah, there's also if your intention is to sell, often it's taxable. There's tainting if you're associated to developers or traders. There's subdivision tax, there's rezoning tax. There's lots of different ways you can get taxed, so I'd always suggest you get advice before selling something. Ring fencing. It's come in from the 1st of April 19. What that basically means is if you've got property losses, you can't offset them against your other income. So if you're earning $100,000 from PAYE salary, you've got a $10,000 rental property loss, you can't offset this, get the two together and just pay tax on the $90,000. Your $100,000 will be taxed, your $10,000 rental loss will carry forward, and it generally means no tax refunds. You can offset one property against another. It depends on your structure for how that works. But yeah, important to think that through. And generally the idea is obviously buy properties that are making money, not losing money, and then this doesn't matter so much. Coming back to this, and then I'll pretty much wind up and pretty much, yeah, near the end of this. So what I want you to think about is, yes, it's really important to think about property, but also think about these other things. Think, yeah, security of your job, insurance, what happens if you have accidents. Think about your KiwiSaver. Is it working in the best way for you? Do you have other investments? Your personal home, can you subdivide it or do other things? And yeah, simple money management can add more to your passive income. So long term, yeah, I want to have a debt-free personal home and passive income, and that can be helped by a variety of different ways. They can all help together. What we're going to do from here is we'll send you through an email tomorrow, and basically it'll suggest that you have a free chat with me. Yeah, we call it a free 5 or 10 minute chat. I can talk pretty much about anything. If you're not sure what's next, you're a bit stuck, you're looking at, is there some opportunities? It's a great way for me to have a quick chat with you and see, is there some easy tax planning opportunities that we can then explore later? The other thing that I'd suggest that everyone takes up, and you can just send me an email if you just want to go ahead with this, and we call it a free financial success plan. The guys at 150 Group would go through, what is your goals? What's your financial plan? Most people don't have goals and financial plan. It's kind of like a thing like, oh, I want to lose weight. Well, the first thing is going, what is my weight now? What is the weight that I want to get down to? And having some goals so you can actually see your progress and work towards something. It's the same with your financial success and your wealth creation. You want goals, you want a financial plan. Yeah, looking at things like, can you borrow more? Is your KiwiSaver working in the best way? Yeah, just general financial advice, and also looking at wealth creation and your retirement plan. So that's completely free. So I'd suggest, yeah, that it's a great idea pretty much for everyone. And a lot of our clients have found it really useful. Tomorrow we'll send you through the email. We'll have my email address, which is there. Our website has, yeah, a newsletter on there and blogs, which you'll find very useful. Things like a restructure is covered in there. So like maybe your personal house becoming a rental and buying a new personal house. Our Facebook has a whole lot of videos. Yeah, a good one that I did yesterday, I think, on a four times 2 bedroom or 4 2 bedroom units in Hamilton, and how the numbers would work and what I'd look for. New Zealand Property Investor Federation, I mentioned, if you're a property investor, I would suggest joining up to it. Costs about $350 a year if you're a couple. It gives you the Property Investor magazine, access to meetings, normally great speakers. You mix and mingle with other property investors and see what they're doing. 150 Group obviously does that free financial success, and Value It I don't mention too much about, but if you're buying a newish property or one with a lot of chattels, we want to do chattels depreciation, and Value It's the only firm that does that. So yeah, thank you very much for attending, and hopefully you've enjoyed this little webinar. If you've got any final questions, chuck them on, I'll try and answer them. Otherwise, yeah, thank you very much, and hopefully you've enjoyed this. Cool. Thank you very much, everyone. I'll leave it there. And yeah, hopefully you have a yeah, great night and enjoy some of the things I've said. Thank you very much.